Good day, ladies and gentlemen. So today I want to teach you how to draw powerful ICT order blocks. Okay, so there are two things that need to be in place for you to draw this order block the right way. The very first one is, let's say you have a candle this way. You have a candle like this. Okay, now the order block has to be below the wick of this candle. Okay, it has to be below the wick, not like at the tip of the bottom part of the wick of this candle. Now there are two criterias which you need to know. One, this candle must take out liquidity. Okay, it could be buy side liquidity, sell side liquidity. It must take out liquidity. That's the first thing. Okay, the candle you use to draw your order block must take out liquidity. Okay, now the next thing is there must be a break of structure. Once these two things are in place, you are good to go. Candle must take out liquidity. That's the candle on which you draw the order block must take out liquidity. Two, there must be a break of structure after that candle has taken out liquidity. That makes your order block very, very solid. So when price comes back to that order block, definitely it's going to go in your favor. Now there are two ways to draw this. The first way is to put the line just at the tip of the wick at the bottom parts. Then you can draw another line. This one is optional. It starts to do with probability. You can draw another line at the middle of the candle, so this becomes a region where price will come back to. Okay, but most times it's going to bounce off this bottom line that you have drawn. Okay, but sometimes it will come in, but it won't go beyond the middle. Sometimes it can stop somewhere around here, then move in your favor. So I just decided to throw that in so that you also get to understand that there's a possibility like that, but most times it's going to move off this your bottom line. Okay, so I have an example around here which I will just use quickly. You have price trending upwards. You can see that creating higher highs and higher lows, then got to a point. This is the highest liquidity created. Okay, so this candle took out the liquidity. Look at this candle right here. It took out that liquidity, and you can see it's even the highest candle there. So this candle swept. There's liquidity around here. Okay, this candle swept that liquidity, this one here. So the bottom of that candle is where our order block will be. I'll use this horizontal line to depict that order block. So the bottom of the candle is right here. The wick, you can see the wick, bottom part of the wick. That's where I placed this horizontal line. Okay, somewhere here. Okay, yeah, so you have that. Now there must be a break of structure. You can see where is the lower high, last lower high formed. This is the last lower high around here. So market must come and break that lower high so that you can have your BOS, break of structure. So once the break of structure has happened, you are good to go. Just wait for price to pull back into that your order block. Okay, then it's gonna move in your direction, and you can see price moved up to the order block with this green candle up to the order block and then moved down. Okay, so that's the idea. You can see it almost no drawdown. There was no drawdown at all. Okay, and even if there's going to be, it will be just small drawdown. You can see entered here, and what you have, price moved down. Okay, the only downside to this strategy is I notice it does not happen often. Okay, it does not happen often. It happens once in a while. Okay, but when it does happen, definitely you see mad risk to reward ratio. Okay, so I have another example that I marked out somewhere, to make it easy so I don't waste time searching for examples. I think that happened on, let's see, where is this example? I have a good, okay, this is it here. So you have market moving in a downtrend, creating lower high, lower low, lower high, lower low. Something else you need to know is that these order blocks are usually, most times, positioned at extremes where you have turning points. Okay, that's something else you need to note. Okay, so we had our liquidity around here. Liquidity was created here. So this is the candle that swept the liquidity. This particular candle here swept the liquidity. This one, this big red candle. So first criteria is met. We have seen our candle that swept the liquidity. Okay, the next thing we want to see is a break of structure. So this level, let me get an horizontal line. This is where we have our lower low. Okay, this is where we have our lower low. We have our lower low here, and you can see this candle broke that lower low and swept whatever liquidity would be here. All right, then we also have a break of structure. Okay, when you are in a downtrend, you're expecting lower highs, lower low. You don't need, once you have a change of character, let's say a set of candles breaking the structure, going past your lower low and your lower high, then it means change of character stepped in. All right, so there's a break of structure, in other words. Okay, so the bottom of this, your big candle that swept the liquidity, is where you place this. If it has a wick, you place it on the wick. This does not have a wick, it has a very, very small wick, but that's the bottom. So once we have our break of structure, which is what you have here, you expect price to pull back to that point in order to do what? In order to move up. As you can see, crazy risk to reward ratio. What do you have here? Look at this big move, crazy. And what's the drawdown? See the drawdown here, see how small it is. So this is what you are risking as your stop loss, and imagine how big the area where you'll be taking profits is. So basically this is just how it works. If you have any question, you can ask me in the comment section. I'll do my best to see what I can do to explain better. Alright, if you are a new viewer, please subscribe and turn on the notification bell. I'll see you in the next video. Thanks for watching.